Hello everybody and welcome to today's video. So today I want to talk about my top 7 stocks, my top 7 positioning for the bull market, the bull run that we are about to enter, I believe 2024. I mean, it's already been a very good year, especially if you've owned Bitcoin. Bitcoin is now my number 1 position, but I believe it's going to continue. We have an election year in the US and in much of the world in 2024, and we also have probably 3 rate cuts from the Fed, maybe more, maybe less, but any rate cut that we don't get in 2024, we are going to get it in 2025. So in my view, we have a few years coming up where our portfolios can do really, really well, which is why I am concentrating in my higher conviction, in my better conviction, more conviction type positions. And as you've noticed on the channel, I've started covering a more focus, putting more focus on certain companies, certain stocks, namely Bitcoin, because Bitcoin, we have the halving coming on April 19th. This is going to be a major event. And we also have good news on a lot of innovative companies. And one of the compelling buy from a true value standpoint, in my view, is the first stock I want to cover, which is Tesla. Tesla is a top asset. It has performed right now 41% average annual return over the past 14 years. This is an asset that, very much like Bitcoin, is under attack 24/7 by just about everybody. Never mind the fact that they did a 200x on their revenue, on their sales, in a matter of 12 years. And they are the best-selling car in the world. And they are launching robotaxis on 8/8, at least revealing, so announcing that they will launch it in the future. That was just a guess. That was just a guess in the past. This is not going to be a guess. We're now going to have a timeline, and I believe this has the potential to unlock tremendous value. And when I look at my valuation spreadsheet and the way it ranks Tesla and Enphase to a lesser extent, we'll get to it in a second, it doesn't rank them favorably, right? My spreadsheet tells me they're expensive, but this is because this is a short-sighted spreadsheet that only takes into account the next 12 months of revenue. If you're new to the channel, really briefly, what is my spreadsheet about? It's about answering the question, how much am I paying for that growth? How much am I paying for next 12 months growth, for the growth that's going to happen in the next 12 months? And it's a spin on the PEG ratio of Peter Lynch. I am not using the PEG ratio because the PEG ratio focuses on earnings, and I much prefer gross profits over earnings, because earnings are just not suited for the 21st century. The way they are calculated, the issues with gap accounting, that would probably need to make a separate video that would get a grand total of 50 views. But the point is, gross profit, in my view, is a much better capture of the economic potential of a firm. And what's important is, how much am I paying for that gross profit relative to the growth over the next 12 months? That's the price to earnings to growth ratio, revisited as EV to GP to revenue growth. Enterprise value I use because I want to penalize companies that have a lot of debt. For example, in this spreadsheet, if I were to have Ford or GM, you'd be surprised Ford and GM would show up as an enterprise value close to 200 billion. Why? Because they have so much debt, because they've engaged in so much revenue financing. My spreadsheet favorizes companies that do not have a lot of debt. Anyways, talking about Tesla at a 1.3 seems very expensive. The reason why it seems so expensive is because I am only putting in 19% of next 12 months revenue growth. We know there may be a slump in sales. That's the 19%. We know the sales may be down. That's likely due to the interest rates. The problem is the interest rates. A lot of people are waiting to buy a car right now because interest rates are still high. But there will be, in my view, a lot of pent-up demand as soon as the interest rates drop. And this is a company that is EBITDA margin profitable at a 16%, and it's nearing the rule of 40. By the way, that's true for Enphase too. Both of these companies are high quality, reach the rule of 40 and have achieved outstanding return over the past 10 years. So that's a good transition to the other stock that I love very much on this channel, which is Enphase. So again, Enphase, if you put Enphase in a total returns calculator and you look at the past 10 to 15 year total return, it blows your mind. It's a company that's up there next to Tesla, next to Nvidia, next to Bitcoin. Enphase is the winner takes most in the residential photovoltaics installation business. What do? They enable installers to set up solar panels on people's roofs, on the roofs of people's homes, through a technology which they pioneered and in which they are the leader, which is microinverters. I've spent a lot of time on this channel explaining why microinverters are the better technology. It is my belief that they're the better technology, and also explaining why it is only logical that most homes in the world will have solar on their roofs. There is more than enough sun eating everybody's houses for them to power 7 to 9 times their need. Roofs are big enough for you to power your electric car, your daily living, and much more. And that is why I believe most houses, when you take a walk around your neighborhood 10 years from now, there will be many more houses with solar. Right now where I live, it's less than 10%. I have no issues imagining in the future where 80% of the homes in my neighborhood have solar on the roof, just because it is so compelling and the payback is just very quick. Solar is one of these areas that has a lot of FUD against it, just like electric cars, and disruption is difficult to understand for anybody who's sensitive to, say, sensational news and actually doesn't open a spreadsheet and calculate for themselves. Savvy customers who take a spreadsheet, input things, whether it is for an electric car, input the numbers for your family if you get an electric car, and look at the numbers, and them costing about $4, $4 to $5 for 300 miles. You can do the same math for solar panels. Solar panels in most regions of the world, once you put them in, it's a payback of between 5 and 7 years. And keep in mind, savings are tax-free. Which is why high-income households are picking up on this. This is going to trickle down. Many more people are going to buy it. Enphase is a company that has been cheaper. You may remember in November it was cheaper, but the company is trading in a range. It's kind of flattish. Some days it's up 5%, others it's down 7%. I am quietly accumulating Enphase because I believe this company will be the winner take most of the market if solar ever becomes a thing. They have the high value density semiconductor main ingredient to the solar equation, right? They don't make solar panels, which is a capital intensive business you don't want to be in. They don't have a bunch of employees that are installers, right? They are the enabler in the background, and I love to own Enphase for that reason. Now, these two stocks, objectively, if you look, Enphase and Tesla, right? Objectively, if you look back over the past 10 years and you look at the performance has been objectively mind-blowing, and they are objectively at the heart of separate technological adoption curves and separate technological revolutions. I want to talk about stocks that I own here, which are HIMS and TransMedics. HIMS, granted, is I believe, well, they're both revolutionary companies in their own right, but right now in their current state, it's disrupting a smaller market, and therefore they are smaller companies. Not to lie to myself or to anybody here, the reason why these companies fell on my radar the first time, either of these, was the valuation. These companies still have extremely compelling valuation. So if you look at HIMS at a 0.11, it is a dirt cheap company. It is the second cheapest company in all of my coverage universe. I have more than 45 stocks that I rate on this spreadsheet. It is the second cheapest at $14 and change right now. The stock, I believe, has gotten cheap again, and I have been accumulating again in the $14 range. Hopefully it falls back to $12 or $13 range. This is a company, HIMS and Earth Health, They are an e-doctor, so a digital doctor, and an e-pharmacy, right? A digital pharmacy combined together without insurance. They don't accept insurance. When you do that, you can have things that traditional healthcare doesn't have, like insane transparency, great pricing. Pricing is oftentimes much cheaper in copays. The transparency is great. You can chat with your providers. And they are a platform, right? They have a platform. So HIMSS has a platforms with thousands and thousands of doctors who are registered on there, and they're kind of Uberized doctors. They're practitioners who want to make a side income, and they register on the HIMSS platform. And HIMSS, on the other hand, as a two-sided platform, it's got potential customers who explain their conditions, explain their issues. Then you get in front of a provider, typically for a chat, but also you could do a video call. And then the provider decides, typically a MD, but not only, it could be a nurse practitioner. The provider, when they see your case, they decide, yes, this person is eligible for this drug, or no, they are not eligible for this drug, right? And if the provider provides a prescription for a product, then HIMSS gets to supply that prescription. That's why they got started with things like ED, with things like hair loss. These medications are recurring medications that you take over the long run, but they are focusing on so many different areas of medicines, minor problems in your 30s, in your 40s that people need recurring medication from. Like a classic example, for example, is metformin, right? But they also have heart health. They have products with statins. They have all sorts of medication for really the more minor health problems of life. You can handle them online, and with HIMSS, you can do that without insurance, which I think is one of the great hacks that HIMSS has found in the healthcare business, because you have transparent pricing, and all of a sudden your customer is not scared about wondering whether they're going to get a bill or not for that consultation in the future, and whether insurance is going to cover it. A question when you cover a company like HIMSS, which is a business model innovation more than a technology, it's not really a technological innovation. They use a little bit of AI, sure, but it's mostly a business model innovation. One question one has to ask themselves is, do we need 45,000 pharmacies in the US? Do we need 45,000 CVS, Walgreens, grocery store pharmacies, etc.? The answer to that, in my view, is obviously not, which is why Amazon is so big right now on Amazon Pharmacy. There's only a few thousands of drugs, not that many. They can be stocked and delivered to you in less than 2 hours with Amazon. HIMSS is kind of doing the same business model, but with less urgent drugs that can be shipped in recurring. They both, in my view, whether it's Amazon Pharmacy or HIMSS or Cost Plus Drugs from Mark Cuban, they all have an avenue for growth. That's insane, because really, the physical pharmacies, it's just too costly. We don't need to have that expensive network. Disruption is coming, and this company is cheap. I've sandbagged the revenue growth guidance at 36%. If you know their long-term revenue guidance, their 2026 numbers, they need to update those. They haven't updated those for us, but it seems like they're going to reach their long-term guidance of 1.2 billion in revenue, 1.2 billion in revenue. They're going to reach that sooner, by about a year sooner. So not February of 2026, but they could probably reach it beginning of 2025, which means that this number would be much higher, the revenue growth. It needs to be updated. The stock would look even cheaper. HIMSS, their long-term goal for EBITDA margin is 30%. So right now, last quarter, they were at 9%. They're going to get to the 30% here. And so you're going to have a stock that's going to have an insane rule of 40, right? It's going to have, a rule of 40 of 80 maybe, 70 to 80, right? And the rule of 40, by the way, is something we owe to the SaaS sector. SaaS VC world, the SaaS investors typically would not consider investing in a firm unless it has at least a 40 when you add revenue growth and the profit margin together. And I'm using EBITDA as a proxy for GAAP type profit margin because I much prefer EBITDA over GAAP. Let me move on to TransMedics. So TransMedics is kind of another 0-to-1 innovation in another niche sector of healthcare. It's actually very interesting how they have the same enterprise value. This is not a typo. This is the actual same value here. TransMedics, what they have is an organ care system. They call it the OCS. They are disrupting organ transplant. So in the past, organ transplants was done mostly through dry ice. You would get an organ, after there's unfortunate accidents, and sometimes people pass away. If they're organ donors, you would have a surgeon get the organ, put it on dry ice, and then it has to fly, perhaps thousands of miles sometimes. It has to fly on the other side of the country, and the problem is that dry ice doesn't preserve the organs nearly as good as an actual machine that mimics the human body. And this is what TransMedics has created. The organ care system is an FDA-approved machine that mimics the environment in which these organs live, and thus you can greatly improve the outcomes of organ transplants with that product. Thus, they are going very, very, very fast. They're an innovator. They're increasing the success of organ transplants. They're actually being very cost competitive to a lot of other options. The reason for that is because they have actually bought their own airline. They bought a flight school. They shut off the flight school. They bought it on the cheap to get the planes. And they now have an airline of very small planes that are just dedicated to organ transplant, which is also one way that you can greatly improve and grow. Because many times out of a year, right, typically 1 day out of 3, private jets are not available for rental to hospitals because maybe there's a sporting event somewhere and all of the rich people rented the private jet out of a sporting event. TMDX has its own planes, and it's got its own organ care system, and it has a blue ocean. It can grow that market, and I don't see that many risks to this company for now, right? The pigs organs, there was a report on the news a while back, and yes, that's very promising, but that's many years away. And same for like mechanical heart or mechanical organs, we're still pretty far away, right? And these overcompeting products have to go through FDA. That's going to be years. I believe TransMedics has perhaps half a decade worth of runway. What I love about it is it's cheap right now, even though it went up 10% the other day. It is still cheap in my view. They gave us long-term guidance. And by the way, that 51% revenue growth, this is not an estimate. This is what they've actually guided for this year. They've guided 51%. That's the company's guidance. So that's sandbagged right there. It may be 70%. That is heavily sandbagged. So this company is very cheap on my metric at a 0.36, and it just blows past the rule of 40 so easily with a 57. Now, let me move on to perhaps the least loved company by Wall Street. Okay, I'm calling it that. I think it's even less loved than Tesla, to be honest. And that's because SoFi is competing directly probably with the employers of these analysts. I mean, sure, you have independent boutique analysts, but most analysts work for the big banks who have independent private wealth divisions. And they see SoFi come, they just entirely bash this company and bash these stocks. But when you look at the number, you realize this is still a company that used to be growing at 50%. They've sandbagged the guidance this year at 22%. I believe that's heavily sandbagged. This is still a company that's growing leaps and bounds faster in the banking system than any of the other banks. They are SoFi and Cash App, and by Cash App I mean the company Block. These two are to me the interesting play in fintechs and in neobanks. This is kind of the same question as for HIMSS and for digital pharmacy studying the neobanks. The question is, do we need tens of thousands of branches, bank branches? Do we need tens of thousands of those, right? Bank of America, for example, has 8,000 branches. Do they need 8,000 branches in a world that is cashless and that is going to be more and more cashless? The answer to that, to me, is an obvious no, and that is why apps like the Cash App from Block and SoFi app, these apps are going so well with the younger millennials, with the Gen Z, who just don't ever need cash. And if they ever needed cash, they would just go to a convenience store, and they have a system where you can use your SoFi account and remove some cash from a convenience store for free, as long as you don't overdo it. So they don't need the cash. These companies are growing very fast. The gross margin for SoFi is 82%, highly profitable business. Revenue growth sandbagged at 22%. They're saying a bunch of the growth is going to come from their tech division, their back-end tech division for over banking clients. The EBITDA margin the last quarter, the one that was achieved, was 30%. So this is a profitable business. SoFi is also a play on the drop in interest rates, because when interest rates get dropped, typically you see much higher demand for loans. I mean, yes, of course, when you study banks, you will see that it's usually a double-edged sword, right? Interests are higher, so you earn higher deposits you earn higher interest on your deposit, but you lend less. But the truth is, it's still better to be a bank in a low interest rate environment, because you end up loaning above and beyond what you do in a high interest rate environment. People just don't want to borrow money right now. It's too expensive. They're still used to the former interest rates from the 2010 to 2020 decade. It's anchored in our mind. And when we see these interest rates at 9 to 15%, say, for like good personal loans, people just run away from those. But they're going to come back down, and when they come back down, I think this is a company that's going to be able to do a lot of good loans. And keep in mind, banks can grow pretty much as fast as they want, as long as they're willing to take the risk. And so now they're prudent. They don't want to take the risk. But everybody wants to borrow money. As soon as the risk environment comes back on, these banks will lend, and SoFi, I believe, will be a key beneficiary. Now, let me conclude this video with Bitcoin. So my Bitcoin stack, if you follow the channel, you know for a while that I've been an advocate of brain wallets and actually owning pure form Bitcoin in a brain wallet. If you are technically savvy, if you're younger, in my view, that's probably a safer thing to do. But nonetheless, we have options today. So the equivalent of owning it in a brain wallet would be to simply own an ETF. But this is a video mostly about stocks. So I want to tell you that I'm increasing my exposure in Bitcoin proxies right now. And there's two companies. Now, I was fortunate to have had a lot of MicroStrategy before it ran up so much. And so I'm happy to own my MicroStrategy actually for the long run. I know a lot of people are saying that they will sell their MicroStrategy at the top. I'm hoping to own my MicroStrategy for the long run. And I think MicroStrategy over the long run, and this is based on a former video that I made a few days back about MicroStrategy, I think that 2x multiplier is going to hold at least, the 2x multiplier on Bitcoin. So if Bitcoin doubles at the halving, could you see a 4x in MicroStrategy price? I think it's reasonable to assume so. The halving is coming April 19th. That means that the daily supply of newly issued Bitcoin will be cut in half in April 19th. In theory, that's a theoretical 2x if the demand remains the same. Now, it might take a few months after the halving for that theoretical 2x to manifest itself, because a lot of people are overstacking. They're overbuying before April 19th, and it's reasonable to assume that after April 19th, a lot of people will stop buying. But over time, they will resume buying Bitcoin at the regular pace that this long-term asset class, in my view, the safer monetary instrument relative to bonds. There's never going to be a vote needed every 2 years to raise the debt ceiling in case of Bitcoin, because there's no debt in Bitcoin. There is no counterparty risk. You own it, right? Money is not debt under a Bitcoin standard. Money is something that you own under a Bitcoin standard. So you don't have that risk that even US treasuries have, that one day Congress doesn't agree to raise the debt ceiling. And I know that sounds crazy to say that Congress could not agree to raise the debt ceiling, but if you think about it, it could happen, right? And that's been brought up by rating agencies. That's been noted by a lot of very, very high-end billionaires, high-end businessmen like Elon Musk, right? It's been noted, like when he said on the call 6 calls ago, we'll see how risk-free it really is. Yeah, think about that. How risk-free is it really if you need a vote every 2 years to raise the debt ceiling, right? I mean, and they use that every time as a political carrot of sorts, every time to say, okay, well, if you don't do what I want, other party, well, I'm not raising the debt ceiling. So imagine the scare every 2 years. That's bonds for you. in my view. That's my view. So the assumption of a risk-free rate, in my view, is not really true anymore. But that's just an opinion. No investment advice, no financial advice on this channel. So MicroStrategy, I'm happy with my position. I actually added to MicroStrategy in the $1,500 range, and I think I like the price. As someone said in my comment section the other day, I like the stock. Yes, I like the stock. MicroStrategy is, it's a double play between shorting fiat currency, shorting the US dollar, and you do that through the issuance of debt. And with that short of the US dollar, with debt that you have to repay way down the line in the future when the currency has devalued, you've taken that debt, you've taken that money, and you've put it in the better asset. And Bitcoin, in my view, is the better asset. I've owned it for a long while. The other stock that I own and that I've added to is CleanSpark. So I made a video on CleanSpark 2 days ago. You may have seen it. Now, CleanSpark, I'm using a 3x as a multiplier because I'm assuming that there's multiple reasons why I'm using a 3x as a multiplier for CleanSpark. So if you watch the video, first of all, we see that it's a 3x earnings, roughly 3x future earnings is roughly what CleanSpark is trading at. So that's one of the reasons. Another reason is they're roughly about triple their hash rate. So that's another reason. And then the question is, what's the multiple? What multiple is the market gonna put on CleanSpark? So somebody asked me in the comment section, which stock do I like more between MicroStrategy and CleanSpark? And to me, it's a matter of risk-adjusted return. I actually have shifted my buys of CleanSpark in a Roth IRA because if we get to a Bitcoin top, it may be that CleanSpark will peak, and I usually don't do this. I generally think it's a mistake to think about ever selling a stock. But in the case of miners, we've had a few cycles and they drop 90% if we ever get into a bear market again. So we'll see, right? We'll see about CleanSpark. But if I sell it, it will be only in a Roth IRA where I don't have to pay taxes on it, right? I own some CleanSpark outside of an IRA, not planning on selling that one. And most of MicroStrategy, some of it is in IRAs, but the main MicroStrategy position for me is not in an IRA, so definitely not planning on selling that ever again. I'm fine with roller coaster. I'm so used to them. But of course, the lasting power of MicroStrategy is, of course, proven, right? This is one of the older companies in the S&P 5. They're not in the S&P 500, but in the U.S. public market. That's one of the older companies out there. Michael Saylor, one of the older founders, still involved with this company. Lots of lasting power baked into a stock like MicroStrategy. CleanSpark is a much newer company. They don't have that lasting power. So, we'll see. If the stock goes crazy, if it ends up doing a 10x over BTC, I might consider selling CleanSpark. Anyways, the point about CleanSpark is right now, at a 15x, I believe it's a great buy. And I've been buying at 15x, at $15, sorry, $15, not 15x, at $15. I've been buying CleanSpark. I've been increasing both of these positions, especially CleanSpark recently. Again, preparing for the coming bull run, because that's what this video is about, preparing for the coming bull run, concentrating on the top positions to make life-changing returns, more than they've already been, right? They've already been so good, like Bitcoin. I was happy owning Bitcoin. I mean, I'm happy owning Bitcoin until the 2040s, more than that. I think borrowing against Bitcoin is going to be a way to go. Didn't expect the performance to come so quickly. And I think a lot of us got caught by surprise by the performance of the Bitcoin assets, to the point that now I'm kind of underweight Tesla and all of these other companies. And hopefully, Tesla, hopefully after the earnings, I'm waiting anxiously for the earnings of Tesla, hoping it drops, hoping to catch it in the 140 range. But I keep buying a little Tesla every other day because the odds are it's not going to drop this low, especially with the robotaxi announcement, the recent one, right? So anyways, to conclude this video, this was not investment advice. This is just entertainment, no financial advice ever. I hope you liked the video. Please like, please subscribe. Thanks for watching. Happy investing and have a wonderful day.